Okay, let's now discuss the profitability evaluation of a company. So, in order to assess the profitability of a company, we need to discuss the financial statements first. So, financial statements are published by companies that are trading on the stock markets uh, every quarter, but we will concentrate on annual reports, so on profits generated for a complete year. Um, these documents are available on the websites of the companies. So if you want to assess the profitability or if you want to obtain the financial statements of the company, you have to go on your website. Then there's often a page labeled investors or investors relations, and then you should be able to download their annual reports. You can also find abstracts of these financial reports on financial websites. You may not be able to find more than 2, 3, sometimes 4 or 5 years worth of values, financial values on these websites, but it's a quick way to try to at least assess if the last 2, 3, 4, 5 years of the company have been good in terms of profitability. In our case, we're going to assess the profitability, but also the trends. So we want to look at the last 5, ideally the last 10 years of the company, to look at the trends, to look at how profits have been evolving. Has it been increasing? Has it been increasing slowly at the high rate, or is it stable? Is it decreasing? So that's going to give us an idea of try to predict the next 4, 5, 6 years of operation of this company. So here on the screen, I have created a income statement of a fictional company, just for the purpose of discussion. So financial statements are normally published for each year, so you will only have the information for 2011 on the 2011 annual report. So you need to open a bunch of annual reports to be able to build such a table. It's a bit time consuming, but once it's done, the goal is to put them in the same table, and we can compare how revenues have been increasing or decreasing. We can also compare gross profits. All of these values can be compared year by year. And what we want to look at is normally the top line, which is the revenues, and the bottom line, which is called net income. The net income is basically the profits of the company after taxes. This is going to be the profitability of the company. So obviously there's a bunch of things, bunch of lines in between, cost of goods, those are expenses, gross profits, salaries, if you need to pay for utilities, all that stuff. So once you subtract all of the expenses, operating expenses from the revenues, you will end up with the operating profits before taxes. This is off. Sometimes some investors will prefer to compare the operating profits because you can compare two different companies while looking at their operating profits. The reason is because so after the operating profits, you need to calculate the tax, and the tax will depend on some accounting procedures, depreciation, interest expenses that may be handled differently by different companies. So some people prefer to stop here and look at the operating profits. In our case, we'll look at net income because it's more widely used. When you get used to surfing on the financial websites, normally people will talk about net income, so we'll concentrate on this value, but operating profits can also be a good metric to use if you want to evaluate the profitability of the company. So in our case, 123 Hardware, which again is a fictional company, we've put the last 10 years worth of income statements, and we see that the last 10 years, their revenues have moved from $3,000 to $8,000. obviously, it's not written, but it's in millions of dollars, but it's irrelevant. We just want to look at trends and profitability here. So it's good to see that the profits grew in the last 10 years and the last 5 years too. So there's a trend here. The revenues are growing. So that would tell us that the company is growing its business, which is good if you want to invest in a company. You don't want to invest in companies that are shrinking in size or seeing its market shares being taken by competitors. You want to see a company that is increasing the revenues. And also you want to look at the trends. So obviously a company that would be making $3 million in 2007 and $3 million in 2016, the trend would be zero, which is not what we want. We would like to invest in companies that are increasing, positive increase per year, to be able to say that this can be sustainable. And we could expect 2017, 18, and 19 to have even more revenues registered on the income statement. So income statement will provide a bunch of information. Look for the revenues and compare the revenues to the previous years and try to see a trend on the last 10 years and on the last 5 years. Then you want to also look at the net income, which is the profitability. Obviously, you can make a revenue, but if your operating expense exceeds your revenue, you will not make a profit, you will make a loss. And you don't want to invest in companies that are making a loss. So how can we know if a company is making a loss? Well, if the net income is negative, then you can expect that this is not a profit, but it's a loss. In our case, 123 Hardware, probably here the first 2 years of operation, they were not making any profit. They were growing their business, so they were making a loss here. They were making a loss in 2008, and then the company became profitable in 2009. And as we can see, most of the year, except 2012, the company has grew its profits, which is a good thing. So it went from making a loss of $274,000 in 2007 to making a profit of $828,000 in 2016. And from 2012 to 2016, the profits have been increasing as well. So we can see a trend that the net income is growing, which is good for us. We want to invest in companies that are growing their revenues, but also their net income. So positive net income, growing revenues is something that we want to look at before investing in a company. Now, making a profit doesn't mean making cash, and sounds strange at first, but in the financial statements, there's a few key documents. One of them is the income statements, which would look a little bit like this. Obviously, 1 year only per year, but if you put them 10 years worth of income statements, you would end up with a table like this. But making a profit doesn't mean that the company is profitable, because a company may make a profit here from its operation, so it's selling more goods than it has to pay to sell them and to fabricate them, but it may have other expenses that are not listed here, such as maybe they have to increase the size of their warehouse every year in order to keep up with the operations. This would not be listed in the operating expense. So there's another document in the financial statements that we want to look at. It's called the cash flow statements. So the cash flow statements is basically, it's similar to the income statement, but it tracks every single cash transaction in a year. So it often starts with the net income. So this is the money that came in the company from its operation. Then it subtracts stuff like account payable, accounts receivable. So basically, it's really the cash balance in the company. If the company decides to invest by acquiring buildings or to new 123 hardware shops, maybe In order to increase the revenue, they have to build new buildings, new stores. Then that's going to be shown on the cash flow statements. It may also have to do some financial transactions, maybe paying dividends to its shareholders. So that's going to be a negative cash. Uh, it's going to be a cash out. Money will leave the company, so that you'll see negative. It may have to borrow money. It may have to pay for its loan. So when you add up the cash flow from the operations and the cash flow from the investment activities and the cash flow from the investing activities, you end up with the total cash flow, which is at the end of the day the difference in cash balance from the year before. So in 2016, the company completed its operating year with $765,000 more than in 2015 because it had to pay for all of these expenses and it generated these revenues. So that's going to be the total cash flow. What we want to do is to invest in companies that have a positive cash flow. That means that the company is creating cash. But we don't want to invest in a company that is generating a positive cash flow if the cash flow is only if the positive cash flow is only generated from the investing, the financing activities. That means that the company is making cash only because it's raising debt. That would not be good. So what we want to do, we want to invest in companies that has positive cash flow from operations. Ideally, also a positive total cash flow. But the total cash flow, if it's positive, it needs to be because the company is making money from its operations, not from its financing. Maybe some companies like banks are investing, so they're generating profits from their investing strategies or investing activities. That's good, but we want to make sure that the cash flow from operations is positive and total cash flow is positive. We also want to look at trends. So in our case here, we see that the cash flow from the operation is growing, except 2012. Let's say that was maybe a down year for the company. But the cash flow from operation is growing, so there's a positive trend here. The company is generating more cash from its operation as we move in time, and that means that the business model is even more profitable. So by using the income statement and the cash flow statements, we can review if a company is growing in terms of revenue, if a company is generating a profit from the net income. If the net income is increasing, that means that the net profit is also increasing. That's going to have a positive impact on our investment performance. But we also want to look at the cash flow statements just to make sure that the company is making money. And we want to make sure that the money it's generating comes from mostly its cash flow operations. Again, it makes money from its investing activities. That's good. But make sure that it's generating positive cash flow and that it's generating cash flow mostly from its operating activities. We will now discuss in the following video financial health, which will be assessed from the third and important document from the financial statement, which is the balance sheet.